TIAA-CREF, one of the largest money management firms in the world, and it does a lot of good work, serves professors, teachers, healthcare professionals, and other worthy professions. The firm first got into private equity around 1997 and made a big splash when it did, as such a big player, and today manages some $6 billion in private equity assets out of a $7 billion alternative investment program altogether. Let's see, how active is the firm? The firm is committing about $500 to $600 million per year to private equity funds. Last year, it also did about $100 million in equity co-investments, along with about $150 million in mezzanine investments and some $270 million in senior leveraged loans. So very big player. And Marina, for almost the last 4 years now, has been in charge of it all, along with high yield and distressed investing. So Marina, this sounds like a big job. Tell us about the team that you lead. Sure. to get it all done.
Absolutely, happy to do that. We have, if I look across broadly the three sleeves that I manage, which is private equity, private high yield, and distressed investing, we've got 13 people in total. Half of that's up in New York and the other half's down in Charlotte, North Carolina. And if I look at effectively the core private equity piece of what we do, along with the related co-investment activity, there's 6 of us, and we are actually all down in Charlotte. And if I look across at that team, it's interesting, the one thing that is the common thread, certainly on the more seasoned levels, and the only exception maybe being our analyst people that have just come out of college, is that we all have deep-seated transactional backgrounds and credit-related backgrounds in terms of our experience.
Now, we spoke a couple weeks ago in the run-up to this event about your private equity program, and a couple of things really jumped out at me. One is that within leveraged buyouts, you're making more of a push into the U.S. middle market, and that reminded me of interviewing your predecessor, Cheryl Schwartz, over the years. And I recall her talking about all the big brand name firms that she was invested with, Carlyle's and Blackstone's and all the rest. Sounds like you're taking things in a different direction. So tell us about the rationale behind that and what kinds of funds you're particularly looking to back.
Absolutely. It's true. In the past few years, we've definitely had a U.S. mid-market buyout focus, and it's really, I think, driven by our desire to go after co-investments in any piece of the capital stack. So we have the capability of doing senior mezzanine as well as equity co-investments, and the middle market provides what we feel is a pretty attractive market opportunity to do that. It's kind of a natural extension to, if you look at the broader firm and the activities and the focus area of the firm, it's a natural extension in terms of the market. It provides additional diversification for the overall portfolio and some good risk-adjusted returns.
Now, equity co-investments is somewhat of a controversial area. Now I've heard there's some academic research out from Harvard showing that co-investments do poorly and the performance has gotten worse more recently. At the same time, at this very conference just yesterday, Michael Elio, who's now was at ILPA, now is at Stepstone, rolled out research showing, well, in fact, our co-investments have outperformed, although bigger deals have not done as well. Tell us about your experience with co-investment performance.
Yeah, absolutely, and it is one of the reasons why I think we've taken this tack on expanding our co-investment opportunities. We don't typically share our absolute returns, but on a relative basis, I can safely say that our co-investment portfolio on the equity side and sporadically when we had done it on the mezzanine side, were definitely accretive to the overall activities.
And what's the key there? Clearly I have to imagine some LPs have not had good experience and have underperformed. What is the key in your view to doing it well? Right?
I personally like to attribute it to the skill sets and the backgrounds that we've got at the firm, as I alluded to before, and this is definitely true of even my predecessors. We've all had strong transactional backgrounds, and it takes, I think, a fair amount of due diligence and understanding. And I know that some of the earlier panels, people were saying you just kind of do things side by side and you check little things. Yes, it's not a re-underwriting of what the GP is doing, but you are getting in there and understanding the dynamics of the deal and the transaction and being able to assess, I think, over the long term, the performance capabilities of that underlying investment.
Mm-hmm. Now, in addition to looking for U.S. mid-market firms that can provide co-investment opportunities, tell us a little bit more about, you know, the U.S. middle market is now huge, and there's just hundreds of firms pursuing a wide variety of strategies. Within the U.S. middle market, what are you particularly looking for and interested in?
Yeah, actually, we're not limiting our scope to, say, if you think about funds that are coming to market in the mid-market space, you've got some that are diversified generalists, you've got some that are sector specialists. I think we, as a group, have looked across the portfolio and are pretty open to most opportunities. I mean, there's always room in the portfolio to add just good funds with good performance.
Okay. And give us a sense, now the 500 to 600 million per year that you're putting out, what does that translate into in terms of the number of actual commitments that you're making, say, and the number of funds that you're backing?
Yeah, I'll put it more in the context of bite size per fund. It's easier, and then everybody else can do the math. But it's probably consistently anywhere from 30 to 60 million per bite on a typical fund deal.
Okay. And does that, does that make does that mean there's a minimum size of fund that you'll do?
No, we've done funds probably as small as 200 million in size, and you know, in the mid-market focus, if I'm talking about it, you know, we've gone upwards of $1 billion or $2 billion, maybe $3 billion in terms of fund size.
Now we also talked about the senior lending that you do, and it sounds like you're doing some hiring in that area. Tell us a little bit about what level you're hiring at, what kind of person you're looking for, and whether that suggests growth in this area for you guys.
Absolutely. The senior leverage lending platform is actually the third leg of the stool in terms of our private equity relationships and our outgrowth on co-investing. And if you think about the firm and the history of the firm, TIAA has been a long-standing player in the debt, corporate, private markets. So we've had a lot of investing in traditional, more fixed-rate private deals, below investment grade. And so we are now sort of going to our GPs and basically saying we can do the floating piece of that. So it's just really a natural extension of what we had been doing. So it is a growth opportunity for us. We are looking, actually we're currently in the market right now, for a first-year associate, which is, you know, probably somebody with 3 to 5 years of experience, MBA type, that is in there doing transactions. And again, we've got that kind of credit culture that if they know how to do their deals and they've got that background, it's going to be beneficial for them in terms of their career trajectory and growth.
Okay, so you have the one opening.
Right now, yes.
Right now, okay. Before I go any further, I just want to make sure that we're addressing any questions that anybody has. Anything? Just raise your hand at any time and we will get to it.
It's always tough to be the last one up.
Kevin?
Are you looking more towards the smaller funds or the larger funds?
Right now, we've been committing anywhere from that, you know, it's 200 million in fund size up to the maybe 3 billion. That's not to say that, you know, if there's a really large fund in the market, perhaps if it's an existing fund in the portfolio with a existing relationship, that we wouldn't necessarily rule them out just because the fund size is, you know, say in the mega category. I think broadly speaking, and the focus is not, you know, only if you have a co-invest opportunity do we want to invest in you. The focus is really more, you know, we want to maintain a broadly diversified portfolio. We do want to emphasize our co-investment activity, but it's not going to be at the expense of a good performing fund with a good track record.
All right.
What about foreign funds? I mean, how do you do your due diligence on funds outside the United States? And what percentage of the assets you look to put outside the United States?
Yeah, right now we're actually not actively investing outside of the U.S. As sort of David alluded to at the beginning, we've been investing in the asset class since 1997, so we've got an already large, well-diversified portfolio, and some of those investments obviously were in foreign jurisdictions, be it Europe, emerging markets, Asia, things like that. You know, the due diligence is more or less on a high level the same. You want to understand the manager, you want to understand their strategy, you want to understand their track record. You know, we take it a step further because we've got the background from, you know, our other credit-oriented activities, so we understand those markets from that perspective and how companies operate from that perspective.
And Marina, did you, as you realized you wanted to make the switch from sort of a large cap buyout portfolio to a more diversified one, did you consider using the secondary market to make that happen more quickly?
No, we actually didn't. And it's interesting that you say that. You know, I think the secondary market has definitely grown in terms of people's desires to, I think, better manage their portfolios, both on the buy side and the sell side. But we've done it more in a homegrown sort of approach. We want to invest, you know, in the funds that are actually coming to market rather than buying, say, a pre-existing portfolio that, you know, might give us scale right away.
Right. Okay. Let's turn to a bigger question, which is, at this event, we've heard a lot of worrying that we might be into a period of frothiness that never seems to end well. How concerned are you about this latest bull market in private equity coming to an end?
Yeah, it's something that I have to say we debate on our team quite often. You know, I think there are certain folks that are out there that have talked about, you know, leverage and multiples certainly being at the 07, 08, if not, you know, pushing up against even higher numbers than at that time frame. And it is something you worry about, not only on the fund side in terms of committing, but also on the co-investment program that we've got. And I think, you know, the answer to that is we're being selective. We're being selective in terms of the co-investment side, what we want to step up for at this point. We don't want to be aggressive in terms of, you know, deals on the leverage side. We're looking for, you know, the structures that are still in place, that are sound. And from the fund side of the equation, you know, I think sometimes you hear about funds that, you know, go to auction and they start to, you know, pay higher and higher prices and multiples. I think what we've heard from some of our recent GPs is that they're actually not stepping up for that last turn of leverage or that last, that means they're obviously losing, you know, the deal. But from our perspective, we view that as discipline, and we're actually pleased that they're doing that.
And in past cycles, I remember when things just feel very, very frothy, you do start to see some limited partners begin to place more money into distressed debt funds, into secondary funds, the kinds of funds that could obviously take advantage of a downturn. Are you at that stage yet? You obviously do distressed investing.
Yeah. We're actually, it's interesting you say that because on the distressed side, we're not doing it through the fund route. TIAA has always had a very long-standing workout unit within the firm. And through that unit, we had been engaging in distressed fund investing over time. But it really is, in our minds, an opportunistic market. And so we decided to take that in-house. And so, you know, in anticipation of perhaps this frothiness turning into, you know, some distressed and stressed opportunities, that team is out there gearing up right now, trying to figure out potentially what names they might want to play in should things turn.
Doing any hiring in that team?
Not right now, no.
All right. Let's talk about what it takes to actually get a commitment from TIAA-CREF. You know, kind of take us inside the organization, and
sure.
To the extent there might be a GP or two out there raising money.
Absolutely.
There always seem to be.
Yes.
What do they have to do to get through the gauntlet at TIAA-CREF?
Yeah, you know, because we're such, well, in our mind, we're a relatively small-sized team. Usually what we do is if a GP first comes to us, we actually get as many of the team to that initial high-level meeting. So they actually have an audience to tell their story and see, you know, after that initial meeting, whether it does sort of fit in the context of the strategy. And after that, we take it to the subsequent levels of diligence and the things you would typically look at, the team, the track record. One of the things that I think is important to us when we look at a fund that's coming to market, you know, especially if it's the third, fourth, fifth fund around, you can easily just take a look at their past track record and say, okay, if you're a fund and this is your strategy, we can take a look at, did you stick to your knitting? If you didn't stick to your knitting, why is that? And those funds that tend to have been, you know, stable performers, been transparent with regard to, you know, their performance and returns and things that have been happening, and those that, you know, if you say that this is your type of deal and we can witness that this is your type of deal, it's probably more likely that you're going to get, you know, a fairly good audience and a good depth of diligence from us.
Now, is there anything that that makes TIAA-CREF experience distinctive? Are there particular red flags or green flags that, from your experience, you're particularly looking for?
Red flags and green flags. You know, I guess some of the things you often see, it's some of the things I alluded to before, when they don't stick to their knitting, why? Have they had management changes over time or team changes over time, why? Those are the natural immediate red flags that come to mind. Then you start thinking about sort of the terms and how have, you know, structures and terms evolved from, say, prior funds to where they are now, and things like that. Are they more LP friendly, less LP friendly, and why? So, yeah.
Let's. You mentioned terms and conditions. Why don't we stay there? How would you characterize right now the relative power that you feel between the limited partners and the general partners?
I think probably in the last, you know, year, 2 years, it's shifted a little bit more to the LP side of the equation. I think that's probably, you know, a function of, certainly on some of the larger funds that may not necessarily have done as well, that have been maybe a little bit more challenged. You know, LPs are looking for a little bit more in terms of what they had gotten relative to the past.
And where you can make some progress, where does that tend to come? Is it on the economic terms or the non-economic terms? Where are you able to make some?
Yeah,
some
I mean,
headway?
you can see it in fee structures potentially. You can see it in you know, waterfall provisions. You can see it perhaps in the key man. You can see it also in terms of, you know, clawback provisions, things like that. So it's, I don't know that it's necessarily one or two things. It's, you know, with each fund, I think it's fund specific. So you pick and choose your spots, and you see if, you know, you can adjust accordingly.
Right. What about for a firm that comes to you, you know, with a lot of confidence, a great track record, you know, it just raises every green flag for you, and it's just what you want to do. But they're like, look, we have enough LPs. We'd love to have you TIAA-CREF, great name. But we're going to charge, you know, a 25% carried interest, maybe some other premium terms. What do you say?
Yeah, that would be a tough one, but my guess is we wouldn't do it.
You wouldn't do it?
No, I don't think we would do it necessarily. It really, I mean, I think I would have to go through the story, meet the team, and our team, in terms of doing our due diligence. I mean, on the face of it, I think you want to be sort of pari with the market. Yes, it may be a good firm, it may, you know, carry an excessive fee, but it sometimes may set a precedent for a direction you don't want to go in.
Just want to check one last time if we have questions. Chris?
You mean on a zombie fund or? Uh-huh.
And I think part of the premise there is that, you know, we have seen some situations where a fund does get to the end of its life, the sponsor is clearly not going to be able to raise another fund,
Yeah.
and limited partners may be complaining to reporters like ourselves that this isn't right. You know, they're collecting too much management fee for the size of the team that they have, and everyone's left. And so the question for you is there anything you can do anticipating that might happen up front in the partnership terms?
Yeah, I mean, I think to answer your question directly, I think there are other terms that we focus on first, rather than getting to that. I think that would be probably a nice to have at some point, and may not necessarily be a focus of all LPs at this point.
How about emerging managers? Marina, are you open to backing a first fund, a second fund?
We have not generally done that as a firm. I think we are open to entertaining meetings with them to get to know them, but we have not necessarily stepped up for those opportunities.
So emerging managers, no premium terms, probably not.
Probably not.
Okay. The final few minutes, I'd like you to take us through the future of TIAA-CREF. You know, where you'd like to take the alternative investment program over the next few years, where you see it heading, and what kind of returns you're expecting to generate from that.
Yeah, I think certainly where we would like to take it is this continued growth that we've been having. First of all, we'd like to have a well-diversified fund portfolio, right? Secondly, I think the co-investment program that we've got from the equity side, the mezzanine side, and the senior side, we'd like to continue growing out that platform. So expanding on those, I think, are very important to us. And the return question that you say, I think that is not a very specific number that we can focus on, but I think of it in the context of really the broader firm and more of a relative value aspect of risk-adjusted return. What are we doing and potentially providing in each of those sub-asset classes relative to what one of our other sub-asset classes in another area is providing for the firm.
Right. And beyond private equity, what are you doing within alternatives?
We're actually engaged, not through my team, but we are engaged in real asset investing. We've got a program in agriculture, energy, infrastructure, and timber. And we've been doing that and expanding upon those programs now for, it's got to be 5+ years that we've been building on those. And it adds a nice diversification aspect, low correlation to inflation, and it's an attractive complement to, again, our existing activities. And
can we expect to see at some point TIAA-CREF get into, I had a question about potentially international markets, venture capital, other areas? Yeah, venture capital has been a piece of the portfolio over time. We have ceased doing venture investing. I think, again, the concept of risk reward, the type of things that I think we'd rather focused on in a constrained sort of bucket of money that you're talking about. There are other avenues that we would rather explore. As far as international markets, the question I think came over from over there. Yeah, it's something I think at some point we would go back into from an alternatives perspective. I can say that the firm itself has continued to be active internationally on more of the debt-related mandates. Private equity, we had and have a large amount of exposure, which is why we haven't really been adding to it.